And nature of auditing. Definition. An audit is an independent examination of financial information of any entity, whether profit-oriented or not, and irrespective of its size or legal form when such an examination is conducted with a view to expressing an opinion thereon. Key features of auditing. 1. Independent examination. Audit must be free from bias, influence, or pressure. The auditor's judgment should never be controlled by another person. Example cases of lack of independence. A CA cannot audit the accounts of his brother's proprietary concern. A CA cannot audit a company in which he himself holds shares. Self-interest threat. 2. Applicable to all entities. Auditing is not limited to profit-making organizations. It applies equally to nonprofit organizations, NGOs, charitable trusts, any legal structure, sole proprietorship, partnership, LLP, private public companies, societies, trusts. 3. Purpose. Expression of opinion. Auditor's main job, express an opinion on the financial statements. Responsibility for preparing and presenting financial statements rests with management. Auditor only examines and expresses opinion by issuing a written audit report. 4. Checks performed by auditor. Ensure financial statements are not misleading. Verify. Accounts are based on proper entries in books of account. Entries are supported by sufficient, appropriate evidence. No important transactions have been omitted. Information is clear and unambiguous. Classification, disclosure, and presentation comply with accounting standards. Financial statements show a true and fair view of results and financial position. 5. Nature. Providing assurance. Audit provides assurance to users, adds credibility and reliability to financial statements, increases confidence of shareholders, lenders, government, and other users. Measure 3. Interdisciplinary nature of auditing. Auditing is not an isolated subject. It draws knowledge and techniques from various fields. Accounting. Basis of audit since financial statements are end product of accounting. Law. Auditor must understand business laws and taxation laws affecting financial statements. Economics. Knowledge of economic environment helps auditor understand the context of business operations. Behavioral science. Needed for interacting with employees, management, and other stakeholders during audit. Statistics and mathematics. Used for sampling, as checking every transaction is impractical. Mathematics helps in inventory verification and quantitative analysis. Data processing, EDP audit. As businesses use IT systems, electronic data processing audit has become an independent discipline. Financial management helps auditor understand working capital management, funds flow, ratio analysis, capital budgeting, production and business functions. Auditor must understand clients' production processes, cost systems, marketing for better audit planning. Number 4. Objectives of audit, SA 200. Main objectives. 1. Obtain reasonable assurance. Ensure financial statements are free from material misstatements, fraud, or error. Reasonable assurance, absolute assurance. Reasonable assurance equals high level of confidence. Absolute assurance is complete guarantee, not possible due to inherent limitations. 2. Express opinion. Auditor must state whether financial statements are prepared in all material respects as per applicable financial reporting framework. 3. Report findings. Auditor must communicate opinion in a written audit report in line with SAs. Scope of audit meaning. Scope equals coverage extent of audit work. Scope includes 1. Coverage of all aspects of entity. Audit should be planned to cover all significant aspects affecting financial statements. 2. Reliability and sufficiency of financial information. Auditor ensures accounting records and source documents are reliable, sufficient for preparation of accounts, evaluated by reviewing accounting system and internal controls. 3. Proper disclosure. Auditor checks whether financial statements properly summarize transactions, follow statutory disclosure requirements, apply consistent accounting policies, e.g., depreciation, inventory valuation. 4. Historical financial information. Audit is always based on past transactions, events recorded in accounts. Scope does not include. Auditor is not responsible for assessing physical condition of assets, machinery, buildings, authenticating genuineness of documents, conducting official investigations. Audit, investigation. Audit, general, broad opinion on financial statements. Investigation, specific, detailed check, e.g., fraud detection. Number 6. Inherent limitations of audit. Audit cannot give absolute assurance because of certain limitations. 1. Nature of financial reporting. Management judgments, e.g., estimates, provisions, involve uncertainty. Internal controls may fail due to collusion or override. 2. Nature of audit procedures. Auditor uses sampling, not checking every transaction. Limited access to information. Management may hide, fabricate. Auditor is not expert in document authentication. 3. Audit is not an investigation. Auditor cannot use legal powers like police or government investigation agencies. 4. Timeliness and relevance. Information becomes outdated. Auditor cannot verify all past events again. 5. Future events. Auditor cannot predict future risks, market collapse, disasters, new competitors. Number 7. Engagement in auditing. Meaning, an engagement equals agreement between auditor and client to provide services. External audit engagements. Purpose, increased confidence of users of financial statements. Example, statutory audit of companies in India. 8. Benefits of audit. Provides high-quality financial information. Protects shareholders' interest, management versus owners. Acts as a moral check, fear of fraud detection. Helps government in taxation. Lenders rely on audited statements for credit decisions. Detects frauds and errors. Reviews and strengthens internal controls. Number 9. Audit, mandatory versus voluntary. Mandatory, companies under Companies Act 2013. Non-corporates under tax laws, if turnover crosses limit. Voluntary, schools, trusts, or other entities may conduct audit voluntarily due to benefits. 10. Appointment and reporting. Appointment of auditor by shareholders in AGM for companies, by partners in firms, by CAD for government companies. Report submission, always submitted to the person authority who appointed auditor. Example, shareholders in a company. 11. Assurance engagements. Definition. Engagement where practitioner expresses conclusion to enhance confidence of users regarding information. Elements. 1. Three-party relationship. Practitioner, responsible party, users. 2. Appropriate subject matter. Financial info, controls, etc. 3. Suitable criteria, standards, laws. 4. Sufficient appropriate evidence. 5. Written assurance report. Types. Reasonable assurance audit, high-level assurance, limited assurance review, lower-level assurance, non-historical info, prospective projections, internal controls. Qualities of auditor must possess integrity, independence, tact, firmness, judgment, patience, reliability, high level of accounting knowledge, professional competence with personal qualities. Number 13, engagement and quality control standards. Engagement standards, ICAI. 1. Standards on auditing for audit of historical financial information. 2. Standards on review engagements, SREs, for review, limited assurance. 3. Standards on assurance engagements, SAEs, for non-historical assurance. 4. Standards on related services, SRSs, for agreed procedures, compilations. Quality control standards, SQCs, ensure audit firms have internal quality systems. SQC1 requires compliance with professional standards and laws. Why needed? Ensure audits are global standard, improve quality and reliability, promote uniformity, strengthen professional skills.